Good afternoon. Welcome to the 2025 Retirement Confidence Survey webinar. The Retirement Confidence Survey is something EBRI and Greenwald Research has been doing for 35 years now. We have a packed program today, so I'd like to get started by first introducing our panel. Obviously me, Craig, Director of Wealth Benefits Research. Our counterpart at Greenwald is Lisa Greenwald, the CEO of Greenwald Research. And then we have a panel of experts from our industry. We have Eugene Hahn, who is Vice President of Multi-Asset Solutions and Capital Group. We have Rebecca Rickart, that's head in Marketing Communications Consumer Insights from Empower, and then David Blanchette, the head of Retirement Research and Portfolio Manager at PGIM. So we will be going through our speakers, but first of all, I want to go through a couple of introductory slides. First of all, I want to thank all of the sponsors of RCS that help fund this survey that Greenwald and EBRI do every year. Three of our speakers are from these organizations, and without them, we couldn't do this survey. So we thank them and would love anyone else to want to be part of this survey in the future to join us. One thing is, we be clear about the survey. We do this in January of every year. We collect roughly 1,000 workers and 1,000 retirees. This year, we are going to be doing an oversample of Black African Americans. That'll be something you can look forward to later in the summer on that report. This webinar will focus on just the general results from the survey and many of the important topics that we have going that. So that is of the important oversight for the survey. A couple of housekeeping items. We are going to go through this presentation. You can ask questions by using the chat function, which is at the bottom of your Zoom bar here. Put it into it. I will then go through and ask the questions as appropriate. We will have a Q&A session at the end. If there is a particular question to clarify something within someone's presentation, I will stop and ask that question, but in general, we'll leave all those questions till the end. So with that, I would like to turn it over to Lisa Greenwald, who's going to go through some of the general findings from the survey, and then we will go to the panel after Lisa goes through that part. Lisa?
Thanks, Craig, and thanks everyone for being here. I'm going to jump right into overall confidence. Here on this slide is confidence among our workers. 2/3 of workers this year reported being very or somewhat confident that they'll have enough money to live comfortably throughout retirement, including a quarter who feel very confident. This is on par with recent years, but as you can see, a decline from 2022. On the next slide, our retirees. Our retirees have always been a little bit more confident than our workers, but this year at 78%, more are confident than they were in 2024, including a third who are very confident. So there are concerns, however. On the next slide, you can see we have 8 in 10 workers and 2/3 of retirees worried about the cost of living, making it harder to save as much as they want. The other really big concern, 8 in 10 workers, 7 in 10 retirees are concerned at least somewhat about the US government making significant changes to the American retirement system. Other concerns of note, 7 in 10 workers, 6 in 10 retirees are worried about stock market volatility and being unpredictable, and that was in January. I want to talk for a moment about the US government making changes to the American retirement system. This year, on the next slide, we asked what concerns our American respondents had in particular. And as you can see, the concerns really hone in and focus around Social Security more so than anything else. 6 in 10 workers, 8 in 10 retirees are worried about changes that would reduce their Social Security retirement benefit. Half of our workers are concerned that there will be an increase in the age at which they would qualify for Social Security or Medicare. Retirees, less so. However, our retirees at 78% are notably more concerned that there would be changes that would reduce their Medicare benefits. Relatively low on that list, though a sizable minority, 3 in 10 workers are concerned about the elimination or reduction of the tax deductibility of their 401k or other retirement savings. But without changes right now in January of 2025, on the next slide, you can see about half of workers are very or somewhat confident in that Social Security will continue to provide benefits of at least equal value to today. So that's really half confident. And
It seems like we've lost Lisa here. I will continue with Lisa's presentation and hopefully that she can catch back up. When you look at it for retirees' confidence, theirs is a little bit higher. It's, it's almost to 2/3. And you could see that 13%. So retirees are a little bit more confident in Social Security like they were in overall in their retirement confidence. And then if you then look at why they have confidence surrounding retirement, it's or other aspects of retirement, you could see that they will have enough money to take care of basic expenses during their retirement. They have enough money to keep up with cost of inflation. Those are some of the reasons why that they're very confident because they can take care, they have confidence in those particular issues. Really at the bottom of the slide of what people think that they have the most confidence in is that they will have enough money to pay for healthcare in the long term, pay for long-term care costs in retirement. Retirees are more confident in all of these things, again, like overall. But again, the confidence of some of these other factors in many cases are lower than what their confidence is, and some of them are higher, particularly paying enough expenses is higher, whereas long-term care is lower and having enough money to last is a little bit lower in both instances. Workers' confidence and financial preparations for retirement. Do they think they're doing a good job for saving for retirement? When you look at workers, you see that this is at 70% of workers that are either very or somewhat confident that they've done a good job preparing for retirement. And only a quarter of people think that are very confident in the job that they have done. So again, overall, you kind of get the same thing. Looks like their confidence overall in not having enough money, which isn't surprising. That should be close to what they felt it should be given their preparations. The retirees' confidence in financial preparation, again, this is a little bit higher, just like what we saw for the overall confidence. We're up to 3/4 of retirees are very or somewhat confident in their job that they've done preparing for financial retirement. But you almost see 40% of people that are very confident in their ability or in their what they thought they did for preparing for retirement. Last year, what percent, almost 50% of people considered that debt was negatively impacting their ability to save for retirement, or if for retirees, 25% thought that debt was impacting their ability to live in retirement. They either strongly or somewhat agree. And you could see that 21% of workers strongly agree. So not only do they feel what their preparations to do, but what their financial situation right now is limiting their ability on what they can do in retirement. And in particular, their finances, if they're not in good shape now, it's going to affect what they can do in retirement. You can see that negative impact of debt. And also another big factor then is healthcare. The cost of healthcare is also negatively impacting about 56%, either somewhat or strongly agree that the cost of healthcare is negatively impacting their ability to save for workers. 35% for their ability to live in retirement is being impacted by healthcare costs. Again, one of the other big factors is debt, and then really their healthcare. As we can see, someone will talk about later, healthcare is a big component of deciding when to retire or retirement being forced upon you. Now, do people know who to go to for good financial and retirement advice? What we see is only 40% of workers strongly agree that they know who to go to for good financial or retirement advice. you see only 16% of workers strongly agree with that statement. When you look at retirees, they're even less on who to go to. That's down to less than a quarter of retirees say they know who to go with for good financial or retirement advice. So there is still a lot of work to go really getting for workers to understand where they should be going for this advice or retirement. And we'll talk more about some financial advice and what people are using for trusted source of information later in the presentation. And one of the big things is we ask for retirees is what they think their lifestyle is. Are you able to spend how much money you want within reason? Are you having the lifestyle that you envision? Do you spend less than you have to because you're worried about running out of money? So the first two, you would hope that you would have a lot of agreement. So you see that over 3/4 of people think that they are able to spend what they want within reason. They either somewhat or strongly agree. You see that over 60% of almost 70% of people, you are having the retirement lifestyle you envisioned. But you do see like 20 to 30% of people aren't in this situation. So while we do have the majority, there are some people that are struggling in retirement, but the majority of people seem to be doing pretty well with their lifestyle in retirement. And then when you ask if they're spending less because they're running out of money, you see little less than half are saying that, but you only see that 13% of people are strongly agreeing that they are worrying about how much money they will have to run, worried about how much they're spending and to be worried about running out of money. So again, their lifestyle looks to be in pretty good shape. For most retirees, you do have those few out there, particularly those that are particularly worried about their situation. And for the next, and a confidence and ability to leave an inheritance. This really trying to figure out, do people think that they will have enough money that they'll be able to live an inheritance? And we see that 61% of workers project that they will be able to leave an inheritance. What's interesting is that retirees, even more retirees, think that they'll be able to leave an inheritance. So again, this goes back to that their lifestyle is pretty much what they have. So they think they will have some money left over to leave an inheritance to their heirs, where we have a full 70% of people doing that. So that really comes through the general overview of the survey. I'm really sorry that Lisa wasn't. Oh, Lisa, you are joined. I'm sorry. I'm sorry to take your thunder, but she will be back for questions of any more of these when we get to the Q&A. But right now, I want to move to our panelists. And we'll start off with going through different subjects. I will introduce each of these other topics that we've had, and we'll let each of our panelists talk about some of the various topics that they have from what they've seen in the industry or for work that they have done that supports what we've found in the survey. So the first topic is retirement preparation. And this is really kind of the first driving thing, really, if people are taking that first step into doing a calculation and figuring out how much they need to save in retirement. And we see that it's roughly about 50% of workers say that they've done this first step to figure out how much they'll need in retirement so that they'll have enough money to last throughout their retirement. We do see a little tick up for retirees, that it's almost 60% of workers said they've done this calculation. But in general, this number has been pretty flat. But although we have seen a tick up in the last few years of people actually taking this step. And this is an important part of really getting in and introducing really what they have. One of the things that we can also then see is that planning for retirement makes people stressful. We see that 65% of workers say that planning for retirement is stressful. Again, this has been up a little bit more, particularly for those that strongly agree that it makes them stressful. We can see that jumped up to 27% this year. And really kind of thinking about this is Empower has done some more work on satisfaction with retirement savings and the stress it can cause preparing for it. So I would like Becca to talk some more about that and what they found.
Thank you, Craig. It's great to be here. Indeed, people are stressed. And if you think about it, between tariffs, geopolitics, volatility, the price of eggs, uncertainty is on the rise. And people feel they have to be a bit of a financial futurist to make heads or tails of it all. So we conducted some new research here at Empower And we found Americans on the precipice of these huge financial choices in a period that we're calling a great decide. And they are in need of financial advice. So in industry terms, we often talk about managed accounts. But on America's terms, we talk about our financial happiness. So how do we measure it? And how do we forecast our fortunes in this unpredictable world? So as you can see on the slide, we asked Americans a fundamental question. On a scale of 0 to 10, how happy are you with your personal finances these days? Let's go to the next slide. Well, right now, it's getting a failing mark. And these scores need improvement across the board. Self-assessment across all dimensions of people's financial happiness is flagging. Americans rate their satisfaction with their retirement savings an average of 4.54 out of 10, and the likelihood of retiring at their goal age of 4.9 out of 10. Contentment with salary notches in at 4.6, and people grade their ability to afford a home at a 4.8. Now, across all these dimensions, like I just mentioned, income, sense of financial success, and satisfaction with their financial plan and getting good advice represents this scorecard for America. And this is the opportunity for our industry. Our goal is to elevate everyone to a perfect 10, however they define it, and give them the products and advice to get there. This is the great decide. And, you know, wherever you are in the industry, financial services companies, associations have a decision too. How do we talk to people about it? Participants, investors, sponsors, advisors, especially when the way that people build wealth is getting less predictable. Let's go to the next slide. Because it is hard to make predictions, especially about the future. Our study found that almost 70% believe the economy is too uncertain to make big money moves. And over half say success feels further away now than it was a year ago, which really makes the case, right? 6 in 10 people say they need trusted advice now more than ever. And 78% say having a financial plan makes them happier and less stressed. So I'll leave it there. Craig, back over to you.
Thank you. Next topic, we're going to look at retirement savings. To go along with preparation, we can see really obviously calculate how much what you need. You actually have to need to save for retirement as the next step. And we can see that it's pretty much consistently around just under or just at 2/3 of workers are currently saving. You get about 70% have ever saved. And when you look at retirees, it's unsurprisingly, that's a little bit higher that have ever saved and currently saving together, where it gets about 80% because they're in very close to that situation or in that situation. You do see a little bit of increase with age on saving, currently saving and saving in the past. But in general, this result is pretty consistent for what we see across years and across ages. One of the big things that we could see is the savings amount that we have seen saved from this survey going back to 2015. You could see that the percentage of people in the higher balance amounts for their current savings and investments, excluding housing and DB plans or Social Security, anything like that, it has gone up. You could see that more and more people are in that 250,000 or more. But one of the biggest factors in that savings is those that have retirement plans. And again, that's not surprising. You know, people are saving if they have in savings plans. But just seeing the stark difference between those with having 250,000 or more, at 46% for those that have a plan versus only 3% with those without a plan, and also at the low end. Most of the low end people are those without a plan. When you see 61% of those people without a plan have less than 1,000 in savings, whereas with a plan, it's only 4%. Again, there's a generational difference, and Becca's done some work with Empower on some generational differences and how much this savings or will this savings be enough? Becca?
Thanks, Craig. Yeah, so when we zoom into younger generations on their retirement journey, we notice things heading in the right direction. Gen Z and millennial wealth, or their average net worth, grew 17% last year, according to Empower data. And what's interesting is that younger generations aren't just built different, as that saying goes. They are building wealth differently than their parents. I'm going to talk a little more about that. So money is on the move. And what's really significant is that it's about to change hands, because the largest wealth exchange in history is here. Let's go to the next slide. And instead of leading to a generational divide, it's leading to a generational decide. Younger generations stand to inherit 78 to 84 trillion, depending on the estimates. And with that, decision-making on saving, investing, and where to turn for advice. And to navigate this uncertainty, Americans see an opportunity to strengthen their personal network, which our study finds people pinpoint at a 5.5 out of 10, like I just shared on those slides a few moments ago. Those valuable connections, often across age groups, are very much perceived as linked to career and wealth building along the retirement pathway. And for almost all, financial independence and interdependence go very much hands in hand, because our survey found that people say not having to rely on anyone else for money is as much a part of their happiness as being able to financially take care of their loved ones. Let's go to the next slide. And I thought it would be fun to put this opportunity into perspective, right? This great wealth transfer is enough to make someone 600 times wealthier than the CEO of NVIDIA, or represents, the ability to buy the entire US stock market and China's too. So our research shows that there are trillions of dollars worth of big decisions ahead, like how to make more money, how to be financially happy, how to start an emergency fund, and how to make a financial plan for retirement and the future. This is the job for all of us in the retirement and planning space. This is that great decide I was talking about. So with that, Craig, I'll turn it back to you.
Thanks. Now that we've talked about savings, preparations and savings, getting money built up, particularly in DC plans, how do we turn that into income so we can use it in retirement? Because one of the things that we're seeing is, we ask this question annually here now for the most valuable improvements in our retirement savings plans, in our DC plans. This year, we did have a change where we have more fund investment options. You can see that came up pretty steeply from last year when it was only 26%. But when you go down to the next ones, and these have been consistently at the top, is for income. How do you produce income in retirement? Guaranteed income products available for after retirement. Really, how do you do this and understand how you change this income in retirement? I'm going to then hand it off to David to talk more about looking at what we can do with DC balances and income in producing income.
Thanks, Craig. So if we go to the next slide, I think one thing that is pretty robust in almost every survey that I've ever seen is that most Americans, especially retirees, are very, very interested in some kind of income that is protected or guaranteed for life, right? We see this in the survey. 83% of respondents are very or somewhat interested. And so I think, to me, what this suggests or just kind of demonstrates that people want help, right? They want a way to easily figure out, how do I take this big pot of savings and create income from that? Now, on the next slide, what we see, though, is that there's kind of similar perspectives on different ways to possibly do that. So here what you're seeing is the appeal of three different possibilities. The first one is a default investment that includes some kind of guaranteed lifetime income product. The second is some kind of exchange that might help someone select among a different variety of options. And the third is a non-protected solution that would help someone figure out income. And I think that across the board, while there are some minor differences in these three items, from my perspective, what this suggests is just that people want help. People want guidance from a professional fiduciary on all these very complex retirement decisions. Now, I think a lot of the focus today, is on lifetime income. And on the next slide, is just kind of, some quick thoughts on how do we proceed here. I've been doing research on the potential benefits of lifetime income for over a decade. And a point that I make a lot is that, thinking about the optimal product or strategy for a participant is really difficult. I think that, too often research focuses on, economic efficiency. We run some kind of Monte Carlo projection, overlay mortality, and call it a day. I think that, in reality, we're all a bit different, right? There's behavioral considerations, and then there's also the product landscape. And what happens then is when you kind of put all these together, it can kind of radically reshuffle this definition of like, what are the best product or products to consider when thinking about what might work in a defined contribution plan. And it's funny, if you ask people what they want in lifetime income, they want everything, right? So on the right, you'll see the results of a survey, asking DC participants about the importance of like income growth, income flexibility, inflation protection, liquidity. Like they want all these things, right? And what's interesting too is when you narrow down the respondent population, based upon, for example, only target ages and maybe even target balances, what you find is that these attributes are especially important there. So at a high level, I'm very excited about the focus in the industry on lifetime income. There's just a lot of things I think to figure out in terms of helping plan sponsors determine what is the right product for them and ensuring that participants get the best product for them as well.
Yeah. Now we're going to turn to that decision of retirement. This is a big thing. Now we've thought about preparing, figuring out how to change the money and income, but we also then have to decide or understand when we're going to retire. So going back to you, David, can we talk more about transitioning to retirement?
Definitely. So like the following few slides are some of what I think are the most fascinating findings in this survey. And why it fascinates me is what I'm always curious about is where are the gaps, right? I don't want to call them blind spots because like some of these things have persisted, as you've demonstrated, for like 30 or 40 years. But like what are the things that people don't always get right in terms of how they're thinking about or planning for retirement? Right. So first, we can think about actual and expected retirement age. Right. This has been pretty consistent for the last 10 or 20 years, but people, tend to retire about 3 years before they expect to do so. So we see, for example, in the latest survey, the average retirement age among retirees was 62. The average age among workers was 65. There's a gap here. People retire 3 years earlier than they expect to do so on average. However, there are some important changes here, right? We do see an increase in the percentage of workers who want to work later. I know that Eugene has a slide here coming up in a little bit. He'll talk about how we've actually seen that play out. But like to me, there is some positive trends here in terms of what we're seeing in terms of actual retirements. And on the next slide, I think like this is really good news. And so what we see here is you look all the way to the right, like this is the percentage of retirees who retire earlier when they expect, about when they plan to do so, or later than planned. Right. So if we go back historically, on average, you could say about 50% of people that retire early, about 45% retire when they plan to do so, and about 5% retire later. Okay, this is a pretty significant shift we've seen in 2024, 2025, where we've moved up where 54% of participants are retiring when they plan to do so. So for me, from my perspective, this is a really positive trend. We're getting more people to retire when they expect to do so versus retiring early, but there still is this gap. On the next slide, it's important to emphasize, well, when this happens, why does this happen? Okay, and you can see here kind of aggregated, and these don't sum to one. You can have more than one response. But 61% of participants' reasons that they cite for retiring early are out of their control. right? And those that, and the most common response is because they could afford to do so, right? Again, most folks don't retire early. This is among those that do, right? Why do they retire early? And most of them are forced to do so. And I think that this fact is really not appreciated when it comes to financial planning. I've been making a point for a long time that financial advisors out there that are doing financial plans for clients, you shouldn't rely on the retirement age that someone tells you. You should kind of adjust that based upon this kind of persistent effect where people tend to retire earlier when they expect to do so. Not always it's based upon what they want to do. Now, on the next slide, we think about, how do individuals actually experience a retirement? And, if we look at this, what we can see is that 50% of workers expect retirement to be a glide path, some kind of like gradual transition that is, maybe 3 or 5 years of working part-time, all these things. In reality, we see that 73% of retirees have kind of a full stop retirement. So to me, there's this big gap here, right? And the gap is a lot of people think their retirement is going to be a glide path when it's actually a waterfall, right? When it happens, and it's not like you had a chance or an opportunity to work part-time or things to happen. It just happens. And so again, like this is relatively persistent. Preparing people for this fact, I think, is critically important. And then finally, on the next one, which is even a bigger gap, in my opinion, is working in retirement. Again, I know that Eugene will talk about this here in a few slides, but I think that there is this massive persistent difference in the percentage of Americans who think they are going to work in retirement and actually end up working, right? So here you can see that in the latest survey, 75% of respondents said that they're going to work for pay in retirement, but only 29% do. Right, so here we can see this, 13%, that's how they work full time, only 2% do. While it's true that some people work part time or full time in retirement, there's a much bigger difference here than you might expect. And so to me, like why this is also important is think about how these add up when it comes to retirement planning, right? People tend to retire 3 years before they expect to do so. Retirement isn't a transition, it's a waterfall. People might expect to work in retirement, they don't, right? So when you add all these up together collectively, it's a very negative impact on overall retirement confidence. So I've got one more slide to cover, the next one, which is just talking about, when people work, why do they work? And, it tends to be reasons around, I enjoy work and want to stay active, then I have to work because I'm broke. And so again, that's really important. It's not like, that minority of folks that do actually make that transition are doing it because they have to. It's because they enjoy the social interaction. So I'll pass it back to you, Craig.
Thanks, Dave. One of the things is we had a particular, point in time that really kind of changed what we saw for trends in working in retirement or working in older ages with the COVID. Eugene has done some research and has some thoughts on that, so I will hand it off to him.
Thank you, Craig. So one of the things that I was thinking about when I was looking through the survey results is how do we combine different sources of data to better understand what has been happening over time, right, and what changes are seeing. So on one hand, yes, people are expecting to work longer relative to the experience of the retirees, right, and we see it, and David talked about this 3-year gap. My first comment on that would be that when we decompose the distribution of what people's expectations, they're really anchored on very specific dates. So you see these spikes around 65, right? So everybody who is far away from retirement would probably think that 65 is a good enough time. Then 62, that's the early claiming age for Social Security, 66, 67 being this full retirement age, again, for Social Security, and 70 as this another kind of benchmark age for this maximum delayed Social Security credit. So thinking about expectations, yes, people expect to work longer, but when you zoom in on the exact numbers, you see them pretty well centered around these milestone ages. So that's one. And the second part of this is what I see is two very strong narratives. So one narrative is the narrative of we are healthier better educated, in the most flexible work environment as we've ever been, right? And so what that does is an expectations for working longer. And if you look at any projection, for example, the employment projections from the Bureau of Labor Statistics, or anybody who does that kind of projection, we'll see that there's a very strong built-in expectation. And in fact, some of the highest growth rates are expected to come from older workers in terms of labor force participation. And indeed, before COVID, if you were to draw a straight line from post-GFC to 2020 and extrapolated that forward, we would have been maybe 2 to 3% higher in terms of labor force participation in older workers by now. But what you do see in the actual data is that over the past few years, while the prime age workers, the labor force participation has completely recovered there and is at, in fact, all-time high, in older workers, in particular 65 plus, we see that there is still that COVID overhang. And so putting together the different reasons why that happened, right? And we've seen for some people, this is because of health reasons or caring for a spouse, but also for some people is because of shifting retirement expectations and people really using this opportunity to rethink and maybe use some of the years that they have in good health to pursue their dreams and pursue their things that they always wanted to do. So in the data, we still see working longer, really baked in all forecasts and projections, and labor force participation well below pre-COVID levels in older workers. Now, going forward, what I think is harder to do is to make a determined call as to where this goes. Somebody can side with the BLS and say, we're going to see this line, right, on the chart, continue trending upwards, right? It will catch up in a couple of years and we're going to be on that same trajectory, or it will kind of continue to linger around the current levels. To me, that simply reinforces the importance of the advisor work and understanding individual circumstances, because what we'll see is some cohorts of people or types of people working longer and some retiring early. And so that divergence is probably continue to be pretty wide. And that is yet another interesting and fascinating perspective that I think advisors should take into account instead of thinking about a number, more about a probability distribution around the retirement age and the various trade-offs there. I'll stop here and back to you.
Thank you. Now we're going to move into sources of retirement income. One of the things we see is that Social Security is the highest expected actual source of income, and it's the highest expected source of income. One of the big changes that we see differently between what retirees say is an actual source of retirement and an expected source of retirement is the workplace retirement savings plans. So many of these things have changed. Many of these things are staying the same. Many of them are, but the biggest one changing really is that money coming from that workplace savings plan. So everything that we have discussed about this is that big issue of how do we get this money in and how do we plan for it to build it up and how do we do it? Eugene has some data on what people are actually doing now with their workplace retirement savings plan to kind of give you an idea of what to expect going forward in this decision to turn these assets into income. Eugene?
So this slide is based on a survey of 2,400 savers, both of younger and older ages. And so what we asked for younger folk is what, in the context of a retirement savings and a portfolio solution, what type of a withdrawal regime would they prefer when they retire? And for retirees, we asked them, what is the withdrawal regime that they are currently using, right? And so here, what we can see is that there is a pretty strong divide. So on the one hand, when looking at retirees, so 60 plus, we see that there is a pretty strong preference for, or not preference, as a lived experience, rather, a better word for that, is that people rely a lot on RMDs and withdrawals as needed. So one hypothesis of why that is the case is that it tends to correlate pretty strongly with the fact that still, even to this day, if you look at the basic expenses, a lot of that part is being covered by Social Security and whatever DB plans people still have. And we've seen from previous EBRI research that we have about a half of 70 plus folk having at least one member in the household with a DB plan. So what that means is that when thinking about the retirement savings is the withdrawals as needed, right? Whenever people have expenses that they need to cover beyond their basic expenses is what people tend to do in the on the portfolio level. Now, when we shift to younger investors, there are a few things happening. So on the one hand, people do expect to have Social Security, but they expect less of it. People also expect less of defined benefit, of course, going forward. We know that there's fewer people with DB currently in the labor force relative to retirees. And we see that desire to have some kind of a paycheck, of a regular income in retirement is perhaps an explanation of why we see a stronger preference for this fixed withdrawal regime among the younger savers.
Thank you. Now, where are people looking for to get this information? We've talked about all these decisions, and we've really pointed to needing help with this. Because right now, when we look at it, the top two sources of information that people, our workers, are going to for their retirement planning are family and friends and online resources and research. The third place is a personal and professional advisor. You do get some work here. You do get some instances where you see your employer's HR or representative from workplace. So if you add those two together, you do get a higher amount there, but you still see that friends and families at the top, and personal financial advisor only comes in around third. You've seen this in other surveys. Becca has done some work and has some thoughts about what individuals or workers are thinking about for their sources of information. Becca?
Thanks, Craig. Yeah, there is no doubt that we live in an influence economy. We've seen it shape political and media landscapes, but it is also shaping financial decisions and where people are seeking their advice. In our study, Americans say financial professionals are the most trusted source of good money advice, coming in at 50%. Maybe surprisingly, compared to just 10% for social media, 9% for AI, and 7% for influencers or podcasters. And with all this talk about AI, we're seeing a low level of concern that AI will replace people at their jobs before retirement. What's driving that? People still want a human touch, right? So their level of comfort in using AI for their personal finances is also quite moderate. So I think we're going to continue to see the types of sources of advice like you just shared and the ones you can see on this slide. Back to you, Craig.
Thanks. David, you've looked at financial advisor use and retirement confidence. Can you talk about the research you found?
Yeah, I always like to start any kind of discussion on the value of advice. I've long been a fan of the value of advice. I did some research back at Morningstar on this idea of gamma, which is just that advisors can help people do a lot more than pick good funds and build efficient portfolios, right? I think that increasingly the role of advisors is holistic to really kind of help them get both to and through retirement, right? I think that if you really look at this slide, the good news is that about 40% of Americans have an advisor. The bad news is that 60% don't, right? And so I think that there's different ways to look at this, but at a high level, 40% or so of Americans today work with an advisor. It's higher among retirees. That's mostly because of wealth. And a lot of those that don't, especially workers, plan to eventually work with one. Right. So again, this makes me happy, and that the number's not zero. It makes me sad, and that it's not 100%. But on the next slide, what we see is that people need help to figure things out. right? And the things that they often need the most help with are, again, more holistic in nature. Am I saving enough for retirement? Have I saved enough for retirement? Do I need to save more? You know, what do I do for long-term care? Yeah, yes, like for the portfolio stuff here is important. What people need, I think, increasingly is someone to help them make better financial decisions, right? I'll often say that retirement is the most expensive purchase that a household makes. It makes sense to try to get it right, right? But like one thing I like to, I do want to kind of just go to for it here in a second is that, you know, a lot of times we hear that you know, people that have advisors are more financially confident, and that's true, but there's a really important caveat there. So on the next slide, I'm going to share some statistics that I actually estimated from the micro data in this RCS. And so the very top, you can see what are the different retirement confidence levels among workers who have an advisor and those who don't, right? So 83% of workers who have an advisor are confident, and only 53% of those that don't have an advisor are confident, right? These are common statistics I see talking about why financial advice is so important. And you know, Greg pushed back at me when I said something. He's like, this is just retirement confidence. I know, it's not a perfect indication of where someone is well-being wise, but there's a really important thing that we need to control for when talking about the role of financial advice on retirement outcomes, right? And that's that Americans that have a lot more money are a lot more likely to have a financial advisor. So if we look at the bottom part of the slide on the left, we can see that the odds of someone having a financial advisor who has less than $25,000 of savings is only about 20%. We can see the odds of someone having a financial advisor who has over $1 million in savings is closer to 80%, right? And then if we look at the retirement confidence levels for those two groups, so those that have less than $25,000 and those that have more than $1 million, we can see this radical difference. So the point here is not to say that advisors can't add value, but when talking about how advisors can positively affect the outcome for Americans, we have to control for things like age and wealth, right? And then on the next slide, I do that looking at the differences in retirement confidence among those who have an advisor and those who don't, for different total wealth thresholds. And like, to me, the really important point here is that based upon all the work that I've done, is that financial advice, you know, there's a question already about like AI and robo I saw on the webinar chat. It has the biggest impact on Americans who don't have a lot of money, right? So the largest differences, this is the increase in retirement confidence and having advice. The largest differences exist among American households who don't receive advice today. So from like my takeaway here is that, you know, again, it's glasses half empty or 40% full or 60% empty, whatever it is. I think that where we need to get more advice to Americans today are those that have less wealth, because they're much less likely to get it, especially outside of a DC plan. Back to you, Craig.
Thanks. Eugene has kind of looked at preferences between investors and advisors. Can you talk about that?
Sure. So what we did in this exercise, we surveyed 1,200 or 2,400 investors and 600 advisors. One of the challenges with understanding people's preferences, both investor and advisor, is that when you ask individual questions, right, separately, people would, of course, choose a portfolio solution that has the least volatility, the highest sustainable withdrawal rate, and, of course, the highest longevity. And so what we tried to do in this exercise is use discrete choice modeling, where we would force some trade-offs. So the way this was built is by having basically have participants go through a screen of on each screen there were 4 choices. In each choice there were 3 parameters that would vary. So one parameter was looking at the desired years of withdrawal, right? So portfolio longevity, desired ending account balance, and maximum account tolerance for account balance loss. And then each combination of these 3 was paired with a withdrawal rate. So the sustainable withdrawal rate was based on a range of long-term macroeconomic assumptions and so on. And so what we see, and people went through these exercise multiple times, right? So choosing whichever combination of features paired with that withdrawal rate was more appealing to them, or choosing none of them. And then through the analysis, we arrived at these conclusions. So a few things to point here. In general, advisors have a little bit higher balance loss tolerance relative to individual investors. Now, what do they use it for? They use it for a longevity protection. Again, looking at the desired years of withdrawal, we see that advisors typically would favor a longer horizon for the portfolio. And then both investors and advisors would prefer capital preservation, right? So basically, advisors would accept a little bit more volatility to provide a higher retirement income for longer, right? And this is, I think, was very important to me, underscore the fact that the value of advice, in particular for this assuring a higher level of retirement income and also protecting against the longevity risk.
Thank you. You can put questions in the chat, so please do that. I have some questions to start with, but first of all, I want to go back with Lisa to let her have some time to provide some of the main points that she was going to provide until we had the snafu. So, Lisa.
Well, thank you. And sorry for the snafu. I think I left off with Social Security, right? And we certainly have seen throughout this presentation the critical role that plays. And it does influence feelings of confidence. I mean, when you ask people, to one of Dave's slides, actually, when you ask our respondents outright, why do you feel confident or not confident? It ultimately comes down to money, right? How much money do they have? Advised, not advised. If they have more income, if they have more assets, whatever your proxy for financial resources, they are more confident. The other point that I think is really interesting is, we worry a lot about workers not saving enough. Workers worry about not saving enough as well. But in the end, there's sort of this feel-good story that retirees are, by and large, 7 in 10, having the lifestyle that they envisioned. And it's important that half say they're holding back on their spending because they're worried about running out of money, but it's only half, and it's only about 1 in 6 who feel strongly that they are holding back. And to me, one of the real telltales, we don't share it often, is that slide about inheritance. We see in survey after survey, Americans worried about running out of money in retirement, but 7 in 10 workers, 7 in 10 retirees, 6 in 10 workers feel confident that if they want to, they're going to have money left over to leave an inheritance. Thanks for my two minutes.
Thank you, Lisa. And I'm sorry that happened. I got a question back on the year. What year was your happiness numbers done, and is there a trend to see if this has changed?
Oh, yes. Well, the study that I ran through today, we just fielded on March 21st. So this data is really fresh. And so you can gather that was right when tariffs were in the picture and Americans were feeling worried about what it would mean for their wallets. So it will be really interesting to see how scores change as the year goes on and into the future.
So that was the first year you did the happiness study?
We have done a previous happiness study, but this is a different sort of score.
Different scale.
Yeah.
Okay.
Mm-hmm.
All right. One of the big issues of thinking about retiring, at 65 or being able to work longer, it's not just the employee's decision, it's the employer's decision. How do you think that, I'll allow anyone to answer this question. How do you think the employers really not wanting to necessarily employ older workers fitting into this situation? No takers?
I mean, I'll point to one of our findings, which is, one of those reasons, top reasons for having to retire earlier than expected is a change at work, right? A downsize, a layoff, lower on that list, and we don't count it as an out of your control reason, is being offered an early retirement package. So, I mean, we don't have within our CS data on how employers view this, but we know that sometimes it's the employer's decision that leads to retirement rather than the individual's.
Well,
Also, go ahead, Eugene.
just to add a few thoughts on that, I think that there is a confluence of different factors here, right? So on one hand, you have the technological change, right? And it's an open question as to whether AI is going to benefit, let's say, younger workers more relative to older workers, or the other way around. And I think that we have evidence pointing into different directions, right? Because on one hand, you have that overall image that in general, younger people are more tech savvy. And so having all of these new tools is something that allows them to be a lot more productive. And sometimes for older people, a little bit harder to learn. Then you have the industry data that basically shows that, in fact, what you see a lot more of right now is in some industries in particular, people hiring fewer juniors, right? So and relying more on the AI tools to do the work that would otherwise have been assigned to somebody who is junior. So one is the pace of technological change and how the tools that people will be using is going to affect, in relative terms, younger versus older workers, right? So that's one aspect that I think will affect how employers think about it. Then there is the overall labor market conditions. And there, one theme would be the fact that we've been in a very strong labor market over the past few years. So that can incentivize employers to be more flexible and have more opportunities to have older workers continue staying in the labor force and try to retain them through more flexibility and things like that. Yeah.
Thank you. David, can you give me a 1-minute answer on what you think can help people, or more likely for people to be taking up annuity products or some type of guaranteed product in the future?
Yeah, I see the question, like, why is there this big gap in utilization of lifetime income annuities versus what people say? And I think there's a host of reasons. I think that we need better products, better solutions, maybe even better defaults. I think that there's a wide acknowledgement of the benefits of these products, but the decision to buy them is difficult. It's not always transparent, but I think that that's changing. So I do think we will see more people in the future utilize lifetime income solutions, and I think that 401ks can be a big part of that.
Well, I want to thank our panel today. I appreciate all of you joining us. So today, we're done today, but look for more of our webinars coming forward this summer. And we are going to be doing a virtual policy forum come this September. So please look for our newsletters and information on those webinars that you'll be getting very soon. And thank you again for participating, and thanks again to our panelists. And you, everybody, have a good day.